OG John AG here. Silver collapsed 31%, finishing the week below $80 and posting the largest single-day loss ever recorded. Not the worst in 10 years. Not the worst in 50. The worst on record, period. $7 trillion was wiped from precious metals in one day. Silver alone fell 31%, erasing roughly $2 trillion. Gold dropped 11%, destroying about $5 trillion. Platinum slid 20%. Palladium plunged 16%. And what I'm about to show you matters. This was not random. This was not organic panic. This was deliberate, and the evidence is there. When you examine the latest COMEX report closely, JPMorgan closed its silver short positions at the exact bottom of the crash. From that moment, prices began to rebound. That's not coincidence. That's not conspiracy. That's documented proof the Friday collapse was engineered. Quick note, about 3 out of 4 people watching aren't subscribed. If this cuts through the noise and helps you see markets clearly, hit subscribe. That's how I know the real community is growing. If this brings value, drop OG John AG in the comments. It helps us understand what resonates so we can serve you better. If it's not your thing, no hard feelings. I'm not chasing vanity metrics. I care about people who want unfiltered truth, not polished, misleading, out-of-touch mainstream narratives. Now let's walk through what actually happened. The COMEX report dated January 30th, 2026 shows JPMorgan Securities stopped 633 silver contracts, precisely at the bottom. Prices crashed from above $100 into the low 70s, and right at the trough, JPMorgan closed those shorts. Immediately after, prices began to recover. This isn't theory, it's recorded COMEX data. Here's the second smoking gun. A total of 2,514 February silver futures contracts issued delivery notices. Physical demand remained strong. Yet on January 30th alone, COMEX Silver traded about 368,561 futures contracts and 28,152 options contracts. Each futures contract represents 5,000 ounces. That's roughly 396,700 contracts, or about 1.98 billion ounces, traded in a single day. Nearly 2 billion ounces. Let that sink in. Annual global mine supply is only 800 to 850 million ounces. More than twice the world's yearly production was traded in one day. That's not price discovery. That's liquidity management using paper silver that doesn't exist. Now connect the dots. The U.S. government nears a shutdown. The Senate passes a last-minute bill. The first U.S. bank failure of 2026 hits. Chicago-based Metropolitan Capital Bank and Trust collapses after Illinois regulators step in over unsafe conditions and weak capital. Assets, $261 million. Deposits, $212 million. FDIC hit, $19.7 million. Polymarket odds of a bank failure on January 31st spiked to 99%. Something big is brewing. Liquidity tightens, and right on cue, paper silver gets crushed. Perfect timing. Totally organic, right? Wrong. Dealers suspend trading. Delivery times stretch to 8-16 weeks. Inventories vanish. Physical premiums decouple. The paper market dumps multiple years of global silver supply in hours. Paper markets purge fear. Physical markets price reality. And when governments stall, banks fail, and trust fractures, real metal doesn't return to market. It disappears from it. Here's the key point. Shanghai spot silver is trading around $122, while COMEX closed near $84. That's a $37 premium, even after a 31% crash. Physical silver in China is trading roughly 44% above COMEX. The premium didn't shrink, it expanded. In crashes, premiums usually collapse. This time they widened. Now let me address 2 groups watching. First, the long-term stackers, about 70% of this channel. Many of you have stacked for decades. You have a plan. Your time frame is months and years, not minutes. A 31% drop doesn't shake you, it creates opportunity. Fundamentals haven't changed. If anything, the growing paper-physical disconnect reinforces your thesis. You're calm, you're focused on the macro picture. Even after this drop, silver is still up roughly 19% on the monthly close. Then there are short-term traders, especially those without a plan. For you, this move was brutal. A 31% single-day crash with leverage is a liquidation event. If you were over-leveraged, undisciplined, or on the wrong side, this wiped you out. Forced liquidations don't care about your thesis. I've warned about this repeatedly. Over-leverage is deadly. If you followed the channel, you knew this was possible. We had a plan. For new viewers, clear statement, I don't sell signals, courses, or mentorship. Real OGs know this. My handle is OG John AG on YouTube and Twitter. If you're not following the real account, you're missing real-time insights. We discussed a possible move to $86 or lower after the Fed chair pick, and it happened. Be aware of fake accounts repackaging my analysis with false data. Verify the handle. No fear, no hype, no sides, just facts. Use your own brain. Know whether you're a long-term stacker or a short-term trader and act accordingly. So what does the COMEX report actually tell us? JPMorgan closed 633 silver shorts at the exact bottom, not near it, at it. then price recovered. That's not luck, that's control. They dump paper supply, trigger liquidations, hit stops, flush weak hands, and then close shorts at the low. It's a flawless trade, visible in the data. This wasn't a correction. It was a deliberate paper massacre. Gold down 10%, silver down 31%. No physical metal was created or destroyed. Fundamentals remain intact. Physical investment demand is strong. Central banks continue buying gold. Silver supply remains tight. Industrial demand, from solar, electronics, EVs, keeps draining above-ground stocks. That creates a firm floor, especially for silver. Miners now have a base to rebuild with upside expected over the next 6 to 12 months as the bull market resumes. Again, 1.98 billion ounces traded in a day versus 850 million annual mine supply. Physical buyers face 8 to 16-week waits. Shanghai premiums hold at $37. Delivery notices total 2,514 contracts. Paper and physical markets are completely disconnected. Add the final catalyst. The first U.S. bank failure of 2026. Not systemic, but it's the first crack. When banks fail, liquidity tightens. Trust erodes. The first phase is liquidation. Sell everything. Even safe havens get hit. But phase 2 is the flight to safety. That's when physical demand explodes. We're transitioning between those phases now. Yes, the bearish case matters. A 31% crash is devastating if you were leveraged. CME is hiking margins after the fall, adding pressure. Survivors now face higher capital requirements or forced exits, fueling more volatility. If liquidity worsens or more banks fail, more forced selling is possible. Paper markets can stay irrational longer than traders can stay solvent. But none of that changes the physical reality. JPMorgan closed 633 shorts at the bottom. Delivery demand persists. Paper volume exceeded twice annual production. Shanghai holds a 44% premium. Dealers suspend trading. Inventories vanish. This isn't a broken bull market. It's a rigged paper market losing credibility. So here's where we land. 3 takeaways. 1. JPMorgan closed 633 shorts at the exact bottom, documented in the January 30th COMEX report. That proves the crash was timed and controlled. 2. Nearly 2 billion ounces of paper silver traded in a day while physical markets scream shortage. Paper is fiction. Physical signals deficit. 3. The first U.S. bank failure of 2026 confirms systemic stress. Initial liquidation comes first, then the flight to safety. 7 trillion erased, biggest daily silver loss ever. First bank failure of the year, 2 billion ounces of paper dumped, and JPMorgan closed at the bottom. That's the smoking gun. The crash was planned, and the physical market is telling you the paper system is running on borrowed time. Do your own due diligence. Understand the risks. Leverage in this environment is lethal, but if you're paying attention to the data, the positioning, the volume, the premiums, you know this move wasn't about fundamentals. It was desperation. One final flush before reality asserts itself. Invest with logic, not hype. OG out.